This Friday, the U.S. will release its January Consumer Price Index data. While the market broadly expects the year-over-year increase to cool to 2.5%, Wall Street is already on edge. In recent years, January inflation reports have repeatedly delivered upside surprises, becoming an annual market jinx. This time, the mix of Trump-era tariffs, seasonal statistical quirks, and corporate pricing strategies makes interpreting the data exceptionally tricky. The path for Federal Reserve rate cuts grows murkier, and U.S. stocks are churning on the clash between expectations and reality. The start of the year is a common window for price adjustments. Gym memberships, streaming subscriptions go up, and holiday discounts end, creating normal price churn. While the Bureau of Labor Statistics applies seasonal adjustments, economists point to significant residual seasonality remaining in the data. Research from the Boston Fed shows that since 1985, seasonally adjusted January inflation has averaged 0.03 percentage points higher than other months. This effect has grown more pronounced lately as service sectors like clinics and pet care increasingly hike prices in January. More concerning, Trump-era tariffs may now be filtering through supply chains to consumers. Nomura notes that tariff costs were passed on gradually last year, and retailers might use the post-holiday pricing window to release accumulated pressure all at once. Adobe data shows online prices for import-dependent categories like computers and home electronics spiked in January, seen as evidence of tariff impact. However, Daiwa Capital's Lawrence Werther argues that the cost of living is a core political issue. With price-sensitive shoppers shifting to cheaper alternatives, giants like PepsiCo and General Mills are proactively cutting prices to protect market share. This suggests companies' ability to pass on costs is constrained by demand, making a 2026 inflation surge unlikely. The back and forth in inflation data has cornered Fed policy. Inflation remains sticky, and a single month's improvement is far from enough for the central bank to confirm a trend. Chair Jerome Powell once compared policymaking without sufficient data to driving in fog. The risk of a hot January print thickens that fog. The Fed already paused in January, halting a streak of 3 consecutive cuts since September 2025 and holding the federal funds rate at 3.75%. Notably, the decision saw 2 dissenting votes, exposing growing internal rift. It's only the third time since 1990 that both hawks and doves have publicly objected. Doves argue for cuts to counter potential labor market softness, while hawks, wary of persistent inflation, prefer holding steady. This split emerged in Q4 2025, when many participants leaned toward pausing in December, before dovish comments later swung market expectations. A stronger-than-expected January report would powerfully support the hawkish case for caution, deepening the policy fog. Furthermore, White House influence over Fed appointments undermines its independence, adding political uncertainty to the mix. The inflation roller coaster and policy uncertainty are fueling significant stock market volatility. This week brings a 1-2 punch of January jobs and CPI data. Analysts warn a weak jobs but hot inflation combo could trigger sharp swings. This volatility stems from the market's current structure. First, valuations are historically high. The cyclically adjusted PE ratio has surpassed 40, a level only seen during the 1999 dot-com bubble. High multiples mean any disappointing data or policy shift can spark profit-taking and repricing. Second, a crack has emerged between the AI narrative and earnings fundamentals. Last year's rally leaned on AI hype and resilient profits, but recent fears of AI displacing software services triggered a sell-off in that sector. Even as chip makers like Micron show robust AI infrastructure demand, strong performers like Broadcom have plunged on worries over the sustainability of capital spending. AI bubble fears combined with shifting rate cut expectations are a core source of churn. Third, global capital rebalancing poses a long-term headwind. The American exceptionalism trade is fading, with money flowing from lofty U.S. stocks to more attractive non-U.S. markets. While Fed cuts may give U.S. equities a short-term boost, they ultimately weaken the liquidity support over the medium term. The upcoming January U.S. inflation report is more than just a data point. It's a key slice revealing the economy's internal contradictions, policy dilemmas, and fragile market sentiment. Whether it's the statistical phantom of residual seasonality or the real pass-through of tariff costs, it will test the Fed's policymaking mettle. As investors chase AI and liquidity-driven returns, they must soberly acknowledge the risks of recurring inflation, unpredictable policy, and rich valuations. As a Baird investment strategist put it, I don't think it's going to be a smooth ride. In this complex environment, maintaining strategic flexibility and balanced asset allocation may be the prudent choice to weather potential 10 to 15% pullbacks. For now, the U.S. economy and its financial markets stand at a new, uncertain crossroads.